Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments, the subscribers. I greatly appreciate it. This week, up JPMorgan Chase, the behemoth in the banking world, absolute titan. Jamie Dimon still at the helm, still crushing it. Let's figure out what this company has done in its history, how much we think it's worth, and what we can earn by owning the stock long term if it's a good investment or not. Ready? We're going to rip through this 10K. Let's get to work. Okay, behind me is the 2020 annual report with the 10K behind it for JPMorgan Chase. Let's go through it. Now, before we do that, let's review the top three key criteria that we use in a bank as we review all banks. Number one, top line revenue growth you've got to have. Number two, earnings growth. We use net income for earnings growth in banks. And number three, we're going to see price per book as a good value here. We're going to judge that value based on how much the economic return is on an IRR basis over time. Now, the first couple things as I walk through this report, first, it's very, very well done, and the bank continues to uphold its great standards and traditions that I've experienced with the people that I've interacted with this as a bank, right? So, number one in investment banking, phenomenal. If you're looking to go public or want to raise capital, ping me privately. I've got lots of contacts within the bank. They do a phenomenal job raising money for institutions. Lots of great topics here. I'll let you read this. Jamie Dimon's statement, again, another legend. You should definitely read what he has to say. Here's where I want to get to. So this is a nice chart. Earnings, diluted earnings per share, and the return on return on tangible common equity. That's what we're going to look for, right? We're going to look at common tangible equity of the business. What is that returning over the long term? And they summarize it nicely over a chart, and you can really see it. The blue line's net income. That's the thing we're going to focus on, is what net income has been doing over the last 10 years or so, 2009 to 2020. You can see it's largely going up. This is kind of the 2028 crisis right there, and the bank has been doing very, very well. Aside from that, this green line is the return on tangible common equity. That's what we're buying, not preferred stock, because they have preferred equity. This is common equity, common stock, and it's kind of hovering in this mid-teens range. It's not 15, not 13, not 17. It's kind of right in there, which is a nice double-digit number, certainly above the S&P 500, which we like to see. The next chart that I also like here is just the book value. So if you're buying a bank, you're buying it because it's got a good book value and it generates earnings off that book value. You can see tangible book value per share has been climbing very, very steadily against the relative price. It seems like in here is probably a really solid value. Price seems to spike recently. There might be a little strain on the IRR because you're paying a whole lot more for the relatively weak growth of the book value, but we'll see how this pencils out. Ready? Let's take a look. Okay, behind me is the book value calculation for the JPMorgan Bank. Let's go through it and figure out what we learn. Total assets, $3.4 trillion in assets, up from 2.3. That's $1 trillion growth over that 9-year span of time, which is fantastic. 4.5% growth, really good number for a behemoth bank. Good for those guys for attracting assets. Again, I think this bank does a great job in terms of talent and recruitment, and I can see it's paying off in the number of assets that they're accumulating. How do we get book value? Well, we're going to subtract from total assets goodwill and intangibles. That's basically premiums they may have been paying for acquisitions or other assets that if they would have a hard time monetizing if they were to be sold. So we're going to pull that off of total assets. Preferred stock and total liabilities, we're going to get those out of there to see what the net assets are, and that's here, book value per share. You can see book value per share, $136 billion. Growing to just shy of $200 billion. That's a 4.6 annual growth rate, which is matching total assets. So they're not leveraging up the balance sheet to do this, which is nice to see. If I keep going forward, I get my growth rate, book value per share growing, which is what we saw earlier, basically doubling in value, almost doubling in value over this 9-year period of time. And the market cap doing the same thing, right? Shares outstanding times price gives you market cap. $170 billion to $400 billion in market cap. Kudos to the JPMorgan Chase team. Good job, everyone. Book value per share, price per book value. This is the relative value metric that we want to take a look at to see how much money we are paying for the stock. And as I indicated earlier with the growth rate, I can probably show it to you right here, with this line, see how this line is relatively close to the book value per share, and then it shoots up like this. This white space here is basically the premium you're paying, and you can see that right here in the price ratio to book. So this is saying 2.2 times book value. This number market cap is twice this book value number 175. Or you're paying 2 years of book value for the business. Same way to think about it. So that's basically where we are right now, 2 times. It's been cheap. It's been low as 1.5 times. That was back in here where they basically had a long history of growth and the market had been ignoring them. Suddenly the market realized what a beast they are. They get a premium, and now it's probably pulling back on its return a little bit by buying the stock at a 2 times. But nevertheless, on average, 1.8 times, which is a healthy premium, right? You normally look at book value 1-to-1 or so as a bank. So you're paying an extra 80% of value for what is a very successful track record from the bank. Let's take a look at revenue and net income. All right, behind me is earnings and revenue for the bank. Let's see what we get. The bank, $91 billion of total revenue. And again, I'm using net interest revenue less the reserves for credit losses. It differs slightly from what you see depending on the page you look at in the 10Ks. All you have to do is take a look at net revenue less the credit loss reserve, and you get these numbers. So $91 billion to $102 billion. That's a growth rate of 1.5%. Not great, but it's growing. Certainly for a big institution like this, it is growing. Net income is growing substantially. So they're widening their margins over time, which is nice to see. 19, almost $20 billion to $34 billion. Sizable drop here in 2020. So all of the banks that we're going to be reviewing have increased their credit, the reserves for credit losses. That means that they've made loans out to customers, and they're saying, hey, look, I might not get all that money back, so I'm going to write off or expense some of the portfolio now as a reserve for the future non-payback. And what you look at is, if you look at what they said $17 billion is what they wrote off in 2020. Prior to that, they wrote off 5.5. So if normal operations is like $5.5 billion of their loan portfolio, they're writing down every year to keep the loan portfolio fair value in line with what's on their balance sheet. And then they jumped that to $17 billion. That increase of about 12 billion, hopefully it's one time. But that means that this number here, this net interest number they have, $27 billion, is lower by the difference of these two, that 12 billion. So if I normalize, I add $11 billion to this, I get $38 billion, which is an increase year over year, assuming that write-down isn't systemic, doesn't happen every year, but next year, 2021, they revert back to average about 5.5 billion. Then what I can do is I can say, hey, look, that growth rate should continue, and this trend that we saw pre-write-down might continue. So I think that 4.1% could be a conservative number. When I look at kind of average before that and average after that, I get a 9% earnings growth, which is fantastic for a huge bank to grow almost double-digit over that period of time. Fantastic. This is why Jamie Dimon is a legend. He is able to grow this bank, and a lot of other banks aren't growing like this. So good for him and good for the team. I'm not going to use 9. It's too high to assume it's just going to continue on modest top-line revenue growth. I'm going to bring it down to use 4.1 for my average, but realize that there could be upside here if it beat it. So just like with Citi, when we reviewed Citi, right, they're chewing up their outstanding shares and they're removing shares here. 3.8 billion to 3 billion outstanding shares, almost a full billion, almost a third they have removed of the shares. So that means if you bought the company back here, not only did you buy a company that's naturally growing revenue and EBITDA, revenue and net income, but your percent ownership of that company is now a third higher. Fantastic. This is really, really good. In fact, this company meets the definition of our trifecta. When we talk about trifecta here in this channel, we look for earnings growth, we look at market multiple expansion, and we look for share buyback. Those three produce an exponential return as your share ownership of a growing business increases, it compounds. And what I mean by that is, like, just look at the natural earnings growth. So your earnings have grown 4%, while the shares outstanding have declined. So these two add up. This 2.5% kind of on top of grows this number. Plus, you get that book value expansion. If you bought it back then, you bought it at basically 1.2, 1.5 times book value. It's now trading at 2. So every dollar of book value is now growing being traded, being purchased at a doubling of value. Those three combination combined for a very, very nice return. Question is, will it continue? I don't know. I don't know if the market multiple here is going to go up a whole lot more, but earnings can continue to go, which I like, and share buybacks can continue, which is what I like. Earnings yield here, I'm going to remove this outlier. I think that's too high, and I'll bring it back down to something average, 7.7%, although I think it could be less than that long term, just based on their growth, but I'll keep it right there. Okay, let's forecast the business and see what we get. So forecasting the business, I'm going to give it 4.6%, just keeping their historical growth rate the same, 4.6%. And I get $200 billion book value, grow to $300 book value. So what's that, a 50% increase over that decade of time, which may be possible. And I've got a 1.8% market multiple, which is the average of this time frame here. No more extra shares. I'm not buying back any shares. I'm holding share count constant. And I get $180 long-term price. Okay, so if I forecast earnings, remember we had a 4% natural earnings growth over that period of time. And if I looked at different chunks, it got up as high as 9%. Well, I don't want to give them the 9% because it does make the forecast really rosy. But the 4% uses the lower last year earnings, so I want to give it a little bit of a boost. So I'm basically taking 60% of that 9% return that we saw, and I'm saying I'll do 5.5% long-term conservative growth forecast with a 7.5% yield, which is what our average was, and I get about a $200 estimate for the stock. So now what I do is I look into this public market. I say I can buy as much stock as I want at $160 a share. I've got two different outcomes. I got a $200 share and I got $180 a share price. Average of those, $190. So I'm buying it at $160, I'm out at $190. Here what I do is I'm going to put the net income that I get, which is currently traded around 7% net income yield, which is a solid yield in this zero interest rate environment. I buy it at $160. I sell it at $190. I get this net stream of cash flow, which gives me a market return of 10%. Now, that is a market return. It's geared to do the S&P 500. And I think what you're seeing is exactly what this chart shows. If you would have bought it historically here in this prime, it was a much better buy. Now that it's run up, I think it's normalized for the market return. There's a premium being paid to the stock. We saw that on price to book ratio. And so I think you have to wait for that to come down a little bit to be a market beating return. But I definitely like the company, definitely like the stock. So, for me at this channel, at this time, what do I want to, let's review our three key factors. Number one, top line revenue growth. Yes, it's definitely growing. For a solid bank, great job. Earnings growth, absolutely growing. Absolutely, yes, it is. Book value is a fair value. So what I'm going to do is I'm going to give it a good. It's not going to be a market beating at these prices, but I like the company. I certainly like the culture. And like I said, I've worked with a lot of people at the bank. And they do a fantastic job. So I'm saying it's a good investment. I would obviously like it cheaper, and if it does go down, I would definitely take a strong look at it. So here's your 160 at 10%, which is a market return on what I would say is a relatively conservative forecast. I like that. If they should beat and continue that earnings growth that I had said earlier, so they can continue the 9% long term, what does that do? That's a 13% growth. And a $270 value at 9%. So I think you've got some upside here. That's kind of why I'm okay with the 10% being a good. If it drops, it gets much better. I definitely like it there. I wouldn't pay much more than 160 for it right now. It's going to cycle around. All right, this is cash flow investing or rational investing. My name is Cameron Stewart. If you like this type of analysis, you want to learn more about securities analysis, I do teach a course on how to value stocks. I provide a template like this. I show you how to read a P&L, an income statement, how to build a forecast, and teach you how to do this on your own. Something that would serve you for the rest of your life. Take a look at my website, cashflowinvestingpro.com, where you can learn more about the course I teach. It does get great reviews from anybody who's taken it, and I highly suggest you check it out. Okay, my name is Cameron Stewart. This has been Rational Investing. This is JPMorgan Chase, the behemoth bank. I hope you like the review. Take care. Bye-bye.